What we're going to go through here is just a nice basic starting point for your calculations of your capital project. I prefer that you had this set up as you came to class. You, of course, are going to be using your data, which can be a little more complicated. Anyway, so we're going to start with the equipment cost. That's whatever your capital expenditure is going to be. The salvage value for you is going to be 0, but go ahead and use a variable here. The life obviously is going to be 10 years because we're doing a 10-year forecast. This example is just 5. Discount rate is going to be your weighted average cost of capital. Reinvestment rate is going to be your weighted average cost of capital again. And the income tax rate is going to be 39%. We'll set up the years with year 0, 1, 2, 3, etc. You'll go out to 10. Year 0 is the beginning of your capital project. For our projects, we're going to assume all the money goes out at one instant in time. In reality, these capital budgets usually get spread out over periods. You can't build a plant in an instant. The year-end annual benefit is going to be right here. For you, I just have numbers in here. For you, it's units times price, that's equal to sales. Units times the variable cost is your COGS. And sales times percent overhead is your SG&A. So the benefit is sales minus COGS minus SG&A, and those are the numbers that you'll include here. Plus, don't forget that your forecast, your sales forecast is going out, so you have to get your percentage increases that are going to occur. Add in here a yearly increase as a variable, and then the annual benefit is going to be simply the number times its potential increase. Right now it's 0. So we want this as a variable that we can kind of play with. Before tax cash flow is simply equal to the annual year-end benefits, except we have minus 100,000 in my case, or minus your capital expenditure in your case, for the cash that's going out. We're using straight line depreciation in your project. I expect to see a straight line, an SDY, and a double. We're not going to deal with the MACRs. You don't know how difficult that was for me to get out. Taxable income is just the before tax cash flow minus the depreciation. That's 22. The tax is just the taxable income times the tax rate, which in our case is 39. And then to get the after-tax cash flow, we take before tax cash flow and subtract taxes. That basically is adding depreciation back into it. And these equations are the same. You can just drag them out. Make sure you pay attention to any dollar signs that are here. NPV calculation. We're going to start right here. Our NPV is going to be just the series of our $sign before, which is our discount rate, weighted average cost of capital, and then the sum of our positive cash flows, or whatever our cash flows after the initial one are, plus the initial cash flow, which is the negative here. So we get to the end, and what you see is a bunch of positive cash flows discounted plus the initial cash flow. So based on these constraints, this is a positive NPV project, basically saying it's worth $22,874.50 just sitting there. IRR calculation, a little bit different. We need a negative number at the beginning. We'll just pick this row to do our running IRR calculation. So B15's $sign, and then we'll drag it out. At the end here we have the entire row highlighted. Our ultimate IRR is 23.22. The basic decision, if IRR is greater than your WACC, it's a good project. Let's go with it. MIR calculation is a little bit different. I'm going to start right out here. And we're still going to highlight the same list in terms of our cash flows. We're going to be interested in our discount rate and our reinvestment rate. So what this is saying is adjusting for what we could have gotten if we reinvested. For example, instead of spending $100,000, I could have bought back some of my stock and bought back some of my debt so that I would have earned my weighted average cost of capital. So this adjusts IRR down for alternative guys. Same decision. If this number is above the WACC, then it's a good project. If not, it's not. I want to do a calculation here for my break-even point. I need to find out automatically what year my NPVs go positive. That's telling me when I'm going positive from a break-even standpoint. First step is we're going to create an if statement. If C16 is greater than or equal to 0, put 1 in, else is 0, and we're going to add to it the previous one. We drag those out, and you'll see we have a 1 here and a 2 here. These are years that are underneath it. The each lookup command, we're looking for the number 1 in this array. It's going to start with the top row. Once it finds the number 1, it's going to go to the second row and report the value. So this goes out and finds the number 1. It reports the value 2, and then we add 1 to it. And finally, we do our calculation for what the exact break-even point is based on a linear interpolation. So just some additional information. And then one of the things we could go for example, is come over to our data, what if analysis and goal seek. And basically, we might want to set the break-even point to a value of, say, 3.2 by changing some change in sales. And can't quite get there, but it gets pretty close. So we need a 17.3% value. Okay, so just ideas on how to get this overall project going, and then when we come into class, you guys will start doing the editing associated with it. All right, thank you very much.